The pursuit of perfect market timing has often been dismissed as a fool's errand by modern academic theory. However, historical evidence suggests that highly structured methodologies, developed long before computers, function as powerful algorithms for market navigation. This system, forged in the crucible of early 20th century trading floors, is not based on complex mathematics, but on the profound observation of human behavior and price mechanics. It offers a blueprint for identifying major sustained market movements with exceptional precision. The premise of this century-old structure is that markets move in predictable channels when under the influence of powerful forces. It posits that true success in speculation comes from recognizing when the market transitions from a stagnant phase to a phase of dynamic movement. This approach treats price action not as random noise, but as a sequence of predictable tests and confirmations that signal the direction of least resistance. The successful application of this methodology transforms trading from gambling into a calculated, systematic process of capitalizing on confirmed trends. We are seeking what is defined here as a perfect breakout, a move far superior to simple price penetration of a resistance level. A perfect breakout is one that is immediately confirmed by momentum, sustained by time, and leads to substantial, hassle-free profits. It is the kind of move that signifies a fundamental shift in the security's valuation and market perception, leaving the previous trading range far behind. This requires patience and the absolute refusal to chase small, unconfirmed fluctuations. The core insight of this enduring algorithm is the necessity of confirmation at every stage. The trader must act as an observer, waiting for the market itself to prove the validity of a move before committing significant capital. This confirmation process involves multiple phases, treating the initial price penetration as merely a signal, not a guarantee. The system insists that the market must validate the move through subsequent price action and persistence over time. This methodology relies fundamentally on observation and the systematic recording of price history to define critical psychological thresholds. These thresholds, once broken and confirmed, release the pent-up energy required for a major market advance or decline. By treating these levels as calculated inputs, the trader eliminates emotional bias and adheres strictly to a mechanical set of rules. The power of the algorithm lies entirely in its structure and the discipline required to follow it without deviation. The first critical step in engaging this algorithm is establishing the line of least resistance. This is the primary directive, mandating that the system is only engaged when the underlying major market direction is clearly and unequivocally established. Attempting to trade against this primary trend, even with the most promising short-term setups, is the fastest route to ruin and invalidates the entire methodology. The trader must first be aligned with the prevailing current before attempting to catch any individual wave. Identifying the line of least resistance requires focusing solely on the major charts, the daily, weekly, and monthly perspectives. These longer time frames reveal the true intentions of the massive institutional capital that drives sustained movements. The short-term fluctuations, the intraday oscillations, and the minor noise must be completely disregarded during this initial assessment phase. If the major trend is up, the system only seeks long positions. If the major trend is down, it only seeks short positions. The fatal flaw of most novice traders is their inability to ignore minor fluctuations in pursuit of quick profits against the major trend. They mistake temporary corrections for reversals, leading them to constantly fight the overwhelming force of the market's primary direction. Trading against the established major direction, even for seemingly small gains, introduces unnecessary risk and dramatically lowers the probability of success. The 100-year algorithm demands patience and absolute fidelity to the overarching market flow. If the major trend of a security is clearly upward, the algorithm dictates that all focus must be placed on identifying opportunities to buy into that existing strength. Conversely, if the long-term trend is bearish, the only valid trades are those that capitalize on further declines. This disciplined focus prevents the capital-destroying habit of trying to pick tops and bottoms, a practice the masters of speculation universally condemned. The market, in its largest form, is always right. and the trader must humbly follow its lead. The initial step of market observation involves a broad assessment of general market sentiment and sector strength. Before applying the method to individual securities, the trader must confirm that the environment is supportive of the desired direction. A rising tide lifts all boats, and trading a strong stock in a strong sector during a general bull market provides the highest probability environment for a perfect breakout. This macro-level confirmation acts as a powerful filter. A security that is attempting a breakout while its entire sector is lagging or declining should be viewed with extreme suspicion. The lack of supporting structural momentum often means the breakout will fail or be short-lived, lacking the necessary fuel for a sustained run. The algorithm insists on trading with the combined momentum of the individual security, its sector, and the general market. This triple confirmation significantly increases the likelihood of a perfect, profitable move. The careful observation of volume during this initial phase also provides critical clues about the market's underlying health. High volume accompanying the major trend confirms institutional interest and commitment to the direction of least resistance. Low volume during corrections suggests that the selling or buying pressure is merely temporary and not indicative of a fundamental shift in the major trend. This observation reinforces the decision of whether to remain bullish or bearish. The determination of the line of least resistance is a continuous process, not a one-time event. The trader must constantly monitor the major time frames to ensure the primary trend has not reversed or entered a prolonged period of consolidation. If the market structure begins to deteriorate, the algorithm mandates stepping aside entirely, waiting for a new, clear direction to be established. Cash is a position, and sometimes the most profitable decision is to wait patiently on the sidelines. The greatest error is assuming that a market moving sideways is merely consolidating for a continuation of the previous trend. Often, long periods of lateral movement represent a deep struggle between accumulation and distribution, where the outcome is uncertain. The line of least resistance is only truly established when the market is clearly making higher highs and higher lows, or lower lows and lower highs. On the major charts, ambiguity is the enemy of the perfect breakout. Only once the line of least resistance is firmly established does the algorithm proceed to phase 2, identifying the pivotal point. This is the calculated trigger, the precise price level where a security transitions from a period of accumulation or distribution into a new confirmed major trend. It is the threshold where the market's psychology shifts decisively, releasing the energy for a substantial move. This point is perhaps the most crucial input in the entire system. The pivotal point is defined as the specific price level that, once exceeded, signals the failure of previous resistance or support to hold. It is the calculated threshold for the breakout, determined through rigorous analysis of price history. This point must represent a clear break from a sustained period of market indecision or congestion, marking the end of the market's internal struggle. It is the precise moment when the path of least resistance becomes an undeniable surge. To identify the pivotal point, the trader must analyze previous market highs and lows over a significant period, often months or even years. The goal is to determine where significant resistance or support was established through repeated tests and failures to penetrate. This historical analysis defines the exact breakout level that, once breached, is likely to trigger stop-loss orders and attract new momentum buyers or sellers. The depth of history analyzed lends credibility to the calculated point. It is absolutely vital to distinguish a pivotal point from a simple recent high. A recent high might be the peak of a 2-week rally which offers little structural significance. A true pivotal point, however, represents the culmination of a long period of internal market struggle, perhaps a high that has been tested and rejected 3 or 4 times over 6 months. This sustained struggle indicates that professional interests have invested significant capital defending or attacking that level. The power of the pivotal point is psychological. It acts as a mental barrier for the majority of market participants. When this barrier finally breaks, the resulting emotional cascade fuels the initial momentum of the breakout. The systematic recording and tracking of these pivotal points are essential inputs for the trading methodology, allowing the trader to set precise alerts and entry plans well in advance. This preparation prevents chasing the market once the move begins. The selection of the pivotal point must be objective and based on visual evidence of sustained resistance or support. If there is any ambiguity about the most significant high or low in a congestion zone, the trader should err on the side of caution and wait for a clearer pattern to develop. The algorithm demands clarity. The pivotal level must be obvious to any observant student of the tape. This clarity ensures that when the breakout occurs, it is recognized by a wide swath of the market, maximizing follow-through. The deeper the consolidation or the longer the period of struggle leading up to the pivotal point, the more explosive the resulting move is likely to be. Time spent in accumulation is market energy being stored, and the pivotal point is the release valve for that energy. Analyzing the duration and tightness of the base formation is therefore a critical component of assessing the potential magnitude of the anticipated breakout. A wide, loose base is less reliable than a tight, well-defined congestion area. The determination of the pivotal point is the algorithmic input because it requires a mechanical, non-emotional calculation based on historical data. The trader is not guessing where the market might go. They are defining the price where the market must go to signal a change in trend. This systematic tracking eliminates the subjective elements that plague discretionary trading. It provides the anchor for all subsequent execution steps. Understanding the pivotal point requires recognizing the underlying forces of supply and demand that create these thresholds. These points are not accidental highs. They are monuments to the intense struggle between professional operators accumulating or distributing positions. If you seek to master the deeper structure of these market battles, you must look beyond surface-level indicators. A foundational understanding of market cycles is essential for interpreting the true meaning of a pivotal point breakout. Many of the principles governing accumulation and distribution were formally codified by contemporaries of the century's great operators. To truly internalize how large interests manipulate price and volume leading up to a pivotal point, a dedicated study of these methodologies is invaluable. We highly recommend exploring the Richard Wyckoff Trading Methods channel, which offers deep dives into the mechanics of market structure and cycle analysis. This resource provides the critical framework needed to distinguish genuine turning points from mere noise, allowing you to anticipate the forces building pressure toward a breakout. Stop guessing about market intent and start understanding the scientific methodology of supply and demand by checking out the link provided below. Once the pivotal point is identified and the line of least resistance is confirmed, the system moves to phase 3, the confirmation mechanism which dictates the structured entry. The core principle of the algorithm is never committing full capital immediately upon hitting the calculated pivotal point. This rule is designed to protect the trader from the inevitable false breakouts and traps that the market sets for the impatient. The entry must be structured, systematic, and always contingent upon immediate market confirmation. The initial crossing of the pivotal point is treated as a signal to initiate only a small test position. This is known as the initial probe, committing perhaps 20% of the intended capital exactly as the price crosses the threshold. This small position serves two crucial purposes. It gets the trader into the move early if it is genuine, and it minimizes losses if the breakout immediately fails. This small stake is the cost of testing the market's conviction. The algorithm demands that the trader views this initial probe as purely exploratory, acknowledging that most initial penetrations fail. If the price immediately reverses back below the pivotal point, the small test position is stopped out instantly, resulting in a minor loss that preserves capital for the next opportunity. This disciplined approach prevents the common mistake of buying a full position only to watch it collapse back into the congestion zone. The test position is the ultimate form of risk management at the entry level. The heart of the structured entry is the three-point rule, which governs the pyramiding of capital into the position. This rule is an absolute mandate against averaging down, requiring the trader to only add to winning positions. Pyramiding is the systematic mechanism for adding tranches of capital only as the market confirms the validity and momentum of the breakout. The system only rewards conviction proven by price action. The first tranche of capital, the initial probe, is entered precisely at the pivotal point. The second tranche of capital is only added when the price moves a predetermined significant distance above the entry point. This movement proves the initial momentum is genuine and that the market has absorbed the selling pressure that was defending the pivotal point. This predetermined distance must be large enough to filter out intraday noise, but small enough to still allow profitable scaling. The determination of the distance required for the second tranche is typically based on the security's volatility or a fixed, historical measure of movement. It must be a distance that clearly indicates the price is moving away from the critical threshold, not just hovering near it. Adding the second tranche signifies a higher level of confidence in the breakout, committing perhaps another 30% of the total intended capital. The capital commitment increases only as the market confirms the move. The final tranche of capital completing the full position is added only when the price moves yet further, confirming the sustained nature of the breakout. This third point of confirmation is the final filter, ensuring that the movement is not just a strong initial impulse but a committed trend change. By the time the final capital is committed, the position is already showing a healthy profit, confirming that the initial assessment of the line of least resistance was correct. This pyramiding process is the core structural element that differentiates the century-old algorithm from reckless gambling. It ensures that the largest amount of capital is only deployed when the market has provided the greatest degree of certainty. The trader never risks a large position on a speculative hope. They only increase their exposure based on factual, profitable movement. This systematic approach flips the risk profile of the trade. The absolute rule against averaging down is non-negotiable within this algorithm. If a position is entered and the price moves back toward the entry price, it signals an immediate failure of the breakout attempt. Movement back toward the entry price means the market has failed to absorb the supply at the pivotal point, invalidating the entire signal. The trader must execute an immediate stop-out, accepting the small loss on the initial tranches. Averaging down means adding capital to a losing position, which is the definition of fighting the market and hoping for a reversal. The algorithm views any movement against the entry price as a warning that the pivotal point was a trap. By strictly adhering to adding only to winning positions, the trader ensures that their capital is always concentrated in the securities that are proving their strength and momentum. This is the essence of trading strength, not weakness. The maximum loss on any single trade is thus strictly controlled and limited to the small test positions and the partial tranches that failed to receive further confirmation. This structured entry mechanism ensures that large capital losses are virtually impossible, as significant capital is only deployed after the trade has already moved into profitability. The discipline of pyramiding into strength is the ultimate form of capital preservation. The specific distances required for adding tranches must be predetermined and written down before the trade is executed. They cannot be decided emotionally in the heat of the moment based on fear of missing out or hope of recovery. The algorithm demands a mechanical execution based on objective price movement targets. This commitment to a written plan removes the subjectivity that ruins most traders. Furthermore, the pyramiding must be done on a declining scale, meaning the first tranche is the smallest, and subsequent tranches may be slightly larger but should decrease in size as the price moves further away. This ensures that the average cost of the entire position is not dragged too high, preserving a wide margin of profit. The goal is to maximize leverage on the initial confirmed move, not to chase the tail end of the rally with large commitments. If the market moves rapidly and skips the calculated intermediate confirmation points, the trader must exercise restraint. The urge to commit the full position immediately must be resisted. If the move is too fast to allow systematic pyramiding, the trader accepts the smaller position size rather than abandoning the structured confirmation process. Discipline trumps profit potential in every scenario. The structure of the entry is a direct reflection of the market's psychological state. The initial hesitation, small probe, reflects the uncertainty at the pivotal point. The systematic addition, pyramiding, reflects the growing confidence as the trend confirms itself. This methodology aligns the trader's actions perfectly with the observable evidence of conviction on the tape. The critical distinction here is between entry strategy and risk management. The initial probe is the entry. The stop-out is the risk management. The pyramiding is the capital allocation strategy designed to maximize returns only after risk has been significantly reduced by market confirmation. These three elements work together seamlessly to create a robust trading structure. Phase 4, validation by time, is arguably the most crucial filter in the 100-year algorithm for achieving a perfect breakout. Many traders focus exclusively on price and volume, neglecting the indispensable factor of time. A true major movement requires time to develop, consolidate, and prove its staying power. It cannot be instantly profitable or confirmed in a single frantic session. The element of patience, therefore, acts as the final gatekeeper for the entire system. A breakout that shoots up and then immediately stalls or retreats within a few days is deemed a failure, regardless of how strong the initial price penetration was. Time validation ensures that the shift in momentum is structural and permanent, not merely a temporary speculative frenzy. The market must confirm itself over a sustained period. If the breakout occurs but the price stalls, drifts sideways, or returns to the pivotal point within a few trading days, the signal is deemed false. This happens frequently when short covering or initial retail enthusiasm provides the impulse, but institutional capital fails to follow through. A true major move is characterized by a continued effort to move away from the critical breakout level, demonstrating sustained buying interest. The market must show its commitment by refusing to revisit the area of struggle. If the price lingers near the pivotal point, it suggests that the supply which caused the original resistance is still active and waiting to cap the move. A perfect breakout is validated when the market begins to move clearly and quickly away from the pivotal point, demonstrating that previous resistance has fundamentally shifted into new support. The time factor is a powerful filter against the shakeout moves designed to trick impatient traders. These false moves often penetrate the pivotal point, only to reverse sharply the next day, catching those who committed full capital immediately. By requiring confirmation over time, the algorithm forces the trader to wait until the weak hands have been cleared out and the true trend is established. This patience avoids costly whipsaws. The observation of the daily close relative to the pivotal point is paramount during the validation phase. A close significantly above the pivotal point on strong volume, followed by subsequent closes that maintain the distance, is the ideal time confirmation. If the price closes weakly near the low of the day, even if it penetrated the pivotal point during the session, the time validation is incomplete and suspicious. A sustained run, the hallmark of a perfect breakout, is characterized by a series of high-volume days that show minimal retracement. The price action should be clean, decisive, and persistently moving in the direction of the confirmed trend. The market should look strong, often closing near the high of the day, exhibiting the kind of one-sided pressure that signals institutional commitment. This persistent strength validates the trade. The trader must resist the temptation to take profits prematurely during this validation phase. If the market is confirming the breakout through time and momentum, the trader must allow the position to run, maximizing the profit potential of the major move. Small profits are the enemy of large profits, and the algorithm is designed specifically to capture the latter premature selling starves the position of its full potential. The same principles of confirmation are used to determine when the movement is slowing or reversing, indicating the appropriate time to exit the position systematically. Just as entry was structured through pyramiding, the exit must be structured through systematic scaling out. The exit is triggered not by hope or fear, but by the market's failure to maintain momentum and its inability to confirm further advances. The signs of a slowing trend include diminishing volume on further advances and increased volume on minor retracements. The price action becomes choppy, failing to make new highs decisively or beginning to close consistently near the low of the day. These are the subtle warnings that the line of least resistance is starting to flatten or reverse, signaling the necessity of scaling out. Scaling out, or distributing the position, should follow the reverse principle of pyramiding. The trader begins by selling the smallest portion of the position when the first definitive sign of weakness appears. They then sell subsequent tranches only if the market confirms that weakness, by breaking key short-term support levels or failing to rally back to previous highs. The full position is only closed when the trend is definitively broken. This systematic scaling out ensures that the trader captures the majority of the major move while protecting accumulated profits from a sharp reversal. By distributing the position, the trader avoids the mistake of trying to sell the absolute top, a futile endeavor. The focus remains on trading the confirmed trend and exiting only when that trend visibly falters. The time element also plays a role in determining the magnitude of the target. Generally, the longer the period of accumulation or distribution that created the pivotal point, the longer the resulting trend will run and the larger the potential profit. The energy stored over months will not be fully released in a week. It demands a sustained run over many weeks or months. This is why patience is the ultimate virtue. If the breakout is validated by time, the trader must use trailing stops based on significant structural levels, not arbitrary percentages. These stops should be placed below intermediate support levels that form as the price advances, ensuring that the market must break its own established structure before the position is closed. The market is allowed to fluctuate, but not to break the trend. The 100-year algorithm is a systematic process of trend identification, pivotal point calculation, structured entry, pyramiding, and time-based confirmation. It is a complete methodology that covers every phase of a major trade, from initial observation to final profit-taking. This structure is what separates the disciplined speculator from the casual gambler, providing a repeatable framework for success. The enduring power of this methodology stems from the fact that it is rooted in fundamental psychological truths of the marketplace. Price action principles, accumulation, distribution, panic, and psychological thresholds remain constant, regardless of technological changes or market instruments. Whether trading stocks, commodities, or modern derivatives, the human element that drives breakouts remains the same. Because the algorithm is based on structured observation of price and time, it is immune to the noise generated by modern news flow and economic commentary. The market itself provides all the necessary information through its own action. The trader learns to ignore the opinions of others and focus solely on the objective evidence provided by the charts and the tape. The systematic process of waiting for the line of least resistance and the calculation of the pivotal point eliminates speculative guesswork. The requirement for structured entry and pyramiding eliminates reckless risk-taking. Finally, the validation by time eliminates the traps of false breakouts. Each phase acts as a filter, ensuring that only high-probability, high-magnitude opportunities are pursued. This methodology still works today because mass psychology dictates that humans will continue to buy high and sell low, and they will continue to cluster their stop losses and entry orders around obvious historical levels. The pivotal point captures this clustering effect, and the confirmation steps ensure the trader is on the right side of the resulting momentum. The market is a machine driven by human emotion, and this algorithm exploits that predictable engine. The final thought must emphasize that discipline and unwavering adherence to the structured confirmation rules are the true keys to replicating these perfect breakouts. The algorithm itself is simple, but the mental fortitude required to follow it precisely, resisting the urge to deviate or gamble, is immense. Without discipline, the most sophisticated system in the world is useless. The trader must accept the reality that many initial signals will fail, and the system is designed to handle these failures with minimal cost. The success of the algorithm is measured not by the frequency of wins, but by the magnitude of the few large wins captured through perfect execution and pyramiding. It is a system built on patience and capitalizing heavily on confirmed strength. The disciplined trader understands that the greatest rewards come not from clever guesses, but from unwavering adherence to a proven structure. This century-old methodology remains the gold standard for those seeking to capitalize on major market swings, demanding patience, observation, and absolute self-control. By waiting for the market to confirm its own intentions through time and momentum, the trader avoids the traps that ensnare the impatient majority. This systematic approach transforms speculation into a calculated, profitable pursuit. The timeless wisdom embedded within this methodology is a testament to the fact that market psychology never changes. Only the instruments evolve. These lessons were meticulously refined by the greatest speculator of that era, whose experiences defined the rules we follow today. If you are serious about mastering the psychological and structural elements required for major market success, you must study the source material. This wisdom is now available in a newly published edition. This new edition of the classic Reminiscences of a Stock Operator offers far more than just the original narrative of Jesse Livermore's incredible journey. It provides deep analysis and unique commentary, accompanying every single chapter, transforming his legendary experiences into practical, actionable lessons for the modern trader. You gain access to a profound analysis of market psychology and the precise strategies used to execute these perfect breakouts, including the exact rules for pyramiding and confirmation. Do not just read history, learn how to apply it to your current trading. Find the link to this essential trading classic in the description now. The 100-year algorithm is not a secret formula, but a rigid framework for observation and execution. It demands that the trader remains a student of the market. Always waiting for the definitive confirmation before committing capital discipline is the price of admission to the world of sustained profitability. Master these phases and you will unlock the enduring power of structured speculation.